if you are trying to have a successful business, it's super important that you have a system of cash flows and budgeting and whatever that looks like, because the number one reason businesses fail is cash flow. And that is why the profit first system works so well, because you should not have cash flow problems. So if you're finding yourself not using that system and having to move money around all the time, get on the system, learn how it works, because if you're using something like that and you're using it accurately, there's no way to go under, because the way the system is set up, you should never have a bill you can't pay.
Welcome to the Profit Answer Man podcast. We believe the purpose of business is to make lots of money. We'll show you how to scale and grow your profit and cash flow, all while working less. We're a big fan of the ELF model: easy, lucrative, and fun. If you're the backbone of America, you deserve to be well rewarded for that. Listen in to see how other business owners are doing it and how to maximize your profit and cash flow. Welcome to the Profit Answer Man, Carlotta Thompson. It's great to have you join us today.
Thanks for having me.
I'm excited for the conversation. I'm a tax geek too. So can you share a little bit about yourself and your business?
Yeah, so I love taxes. I started studying tax law at 14, went to college, got a double major in accounting and finance. And while I was going to college, I did some tax returns on the side, but I went into this big box place that did tax returns, and I took my friend's return in that I'd done, and they put it in the system, and the refund they were going to get home was $2,000 less than what I was going to get home. And I was like, what in the world? How did I come up with $2,000 more in refund than what you did? And that was the day I learned that there are lots of different ways to do taxes. And probably if you put 20 accountants in a room, we're all going to do the tax return differently. But what's the coolest thing is who can get back the most money or help you pay the least tax legally possible. And that is what drives me. So I thought that I could go and teach all the accountants of the world how to help business owners pay less tax. So I was like, I got to go to the IRS. That's where I got to go. So because at 14, when I started studying tax law, the reason why I started studying it was because I got in the mail a booklet from the IRS that said, hey, this is how you fill out a 1040. Okay. And so I became obsessed with that booklet. And so in my mind, the IRS was this big education company that wanted everybody to pay their fair share, but not 1 cent more, right? And so I thought, since the first materials I ever got from them was educational, that I could go there and really make a difference. So when I left college, I went to the IRS, and the rest is history. I thought you would roll me out of there in a body bag. I thought I would be there for the rest of my life. I loved it so much because I love tax law. But what I realized when I got there is I was running people's lives every day. And so when I would do an audit, I would help them. Like I would say, okay, so in the future, you need to do this, this, and this, so you don't have to pay all these taxes anymore. But I'm going to have to give you this large bill because you didn't do that in these years. And you couldn't do it backwards, right? And so anyways, I stayed at the IRS for 7.5 years and thought I would spend my life there. But I decided to come on the outside and help business owners pay less tax. So I left the IRS to come help you guys. And I still, to this day, I miss learning everything that you could learn there, but I find myself, I probably spend a lot more hours studying now because I get to go read what Congress is doing. And so what I do is I go read all these congressional rules that Congress come out with, because they're who makes the tax laws. It's not the IRS. I go read all of that, bring it back down to the middle class business owners. And that's why we're here, because we want to help all of our business owners pay less tax.
Do you read the tax court?
Yeah, we definitely read the court. But what I'm trying to do, I'm not trying to look at like what's going backwards. Okay. I want to know what's coming forward. I want to be the first one to say, okay, this came out. Okay. How are we going to strategize to fit within what the government's going to do next? Yes. Obviously, as an IRS agent, you were constantly reading up on like, how do I fix what's happening in 22 or 23 and it's 25, because court cases are really of things that have already happened. They're not getting to court until it's already in the past. So yes, we have a tax attorney on staff. We're constantly reading court cases. But what I love is what's coming out. That's where I thrive, because there are constantly new tax strategies that you can use as a business owner.
There are, and a whole bunch of them just kind of changed this year. And a lot of people still are digesting them, and maybe we'll get to that. Before we do, you have a lot of clients who use Profit First.
Yeah.
What have you noticed with your clients that use Profit First?
So the ones who are actually using it correctly, because there's a lot of you guys out there that use it, right? We all love Profit First, but the ones who are using it correctly, they definitely budget their money better. They have wealth on into the future. They're not robbing Peter to pay Paul all the time. But then you have a lot of people who are setting up 15 bank accounts and never using them, which is a disaster for your accountant, just so you know. So if you're going to use Profit First, let's use it correctly. And it is so good for the people who are actually using it and making, because it's a budgeting system, right? And as a business owner, you have to have a system that is for your business, and then you have to have a system that's kind of for you personally, right? And so I taught personal finances for years before, while I was at the IRS as part of church ministry. And when I became a business owner, I was like, whoa, okay, we need to determine how we're going to do this separately, because when your brain is thinking for your personal finances, is a lot different than when your brain's thinking for your business, right? With your business, we got to think about growth. We got to think about, what are we going to do next? How are we going to invest our money? How are we going to grow our business? When we're thinking about our personal finances, like I always tell people, and I know Profit First, they probably don't believe in debt, but I am a person that I believe in debt when it's business debt. I actually love business debt. I hate personal debt, right? So personal debt, I despise. So I have to have a different mindset with my personal finances and my business finances. And so one of the biggest things that business owners struggle with is actually creating two different systems. And Profit First makes you pay yourself. Right. And so then you can actually have a budget for your personal finances, because most business owners, they literally just live out of their business if they don't have Profit First. It's horrible. So, anyways, yes, Profit First is amazing. Just make sure if you set up all those 15 bank accounts, please utilize them, because my gracious, when you've got all those transfers, expect, your accountant to take a lot of hours to do those things, which is totally fine. But if you're not using them, let's get with our coach and remember why we set this up in the first place, and let's start utilizing them.
It should not take your hours for all those bank accounts. It really shouldn't. And I'll tell you why. The majority of the bank accounts are your tax account, which you keep putting money in every month,
Yeah.
but you only pay taxes 4 times a year. So that's 5 transactions. That really, well, 4 going out and a handful coming in. It
And
shouldn't take long.
it should not take long. The problem, when we were talking about this, the problem is the business owners aren't using them that way. So what I'm finding is that they're transferring all this money around to those accounts that really should not be transferred money around to constantly. So
Yeah.
it's like they're borrowing from their tax account, and then they're putting the money back, and then they're putting it back. It's that's what I'm saying is, if you're not using the system correctly, it does cause, a lot more accounting, because if you're taking from that and then putting it back, taking from it, putting it back, it does cause a lot more transactions. What I love is, not really, but what I see is that people use their tax account for expenses. All right. And then they're like using this account over here, and it's for, paying yourself, and they're using it for 47 other things. And so anyways, if you're using the system correctly, no, it should not take long, because you're just transferring it one time, right? And then you pay your taxes out at the end. But when you're, again, not using the system correctly, it can create a lot of fun for your accountant.
Yeah, and that's kind of the key. It's an early warning system, but you do have to use it correctly. And that's the problem for a lot of these people, is if they aren't doing it correctly, then so be the issue.
Right. And that's why you have a coach, right? That's what I love about that whole community, is there's lots of coaches to help you and keep you like on the straight and narrow to use it correctly, and to help you get a padding in there and to coach you through that.
Very true. The other thing that we talk about, because a lot of people, the reason they're moving the money is because there's something wrong in the business,
Ooh, that's good. Yeah.
right? And they're not addressing the underlying problem, which is there's something wrong in the business. They're just moving the money and not solving the problem. So it's never going to work. And that's why I think a lot of people get frustrated. And they just got to deal with it. That's all. But let's really talk about the fun stuff, which is not paying the IRS. As you worked with the IRS, what is that like? Like, because people are always scared of the IRS, but there's really no reason to be scared of the IRS.
No,
So
I
let's
love
talk
the
about that.
Yeah. So, really, guys, being a business owner means at some point you're probably going to get audited. If you're a business owner for 40 years and you never have an audit, that's very rare. Okay. But also, an audit doesn't mean anything. Like, who cares? I'm like, bring on the audit. I don't care. Because if you have someone that is on your side and you're not doing anything shady, which means you're not hiding income or anything like that, you should be just fine. Now, the things that I do see people mess up on when they're getting audited is they don't have their records. They have accountants that don't want to help them get their records together. So I'm going to say the biggest thing when you're in an audit is to make sure you have good representation that's not scared of the IRS. Did y'all hear what I just said? You want representation that's not scared of them. Because if your accountant is scared of them, I'll tell you what happens. Your accountant just says, oh, just make the adjustment. Oh, just make the adjustment instead of helping you recreate the records. So when you're in an audit, you can actually use the Cohen rule to recreate records for the government, but nobody knows this. Like it's a very hidden thing. So the IRS will let you recreate things. Now, there are specific things they will not let you recreate. One being travel. You have to have the actual receipt when you travel. You have to have the actual receipt for, and when I say you have to have the actual receipt, I mean take a picture of it. But you can't use a credit card statement, okay? You have to have an actual receipt. On meals, you have to put who the meal was with, what it was for, all right? If you do real estate pro, you have to have the hours that you worked in the business and they have to be contemporaneous. I hate real estate pro, but a lot of accountants push real estate pro. So I'm going to tell you, have a log. The IRS will not let you recreate your log in an audit. Ridiculous, I know, but they won't. And then a lot of people don't realize you have to have a mileage log. You have to have a mileage log. I don't care if the vehicle is used 100% for business use. You have to have a mileage log. A lot of people don't realize that. And use your phone, put My IQ on it, let it trace you around everywhere. I don't care what you have to do. There's so much technology now. You don't have to write this stuff down. Just put a chip in your car, it goes where your car goes and it's a GPS tracker and it'll log it. There's lots of different little tools you can use, but you have to have a mileage log if you write your car off on your business. And again, record keeping is the IRS's love language. Okay. Record keeping. So they want to know that you have the documentation. It's not, another thing that I'll say is, it's not, can I deduct this? It's, do I have the documentation to deduct this? And then if you don't, go ahead and deduct it, but just know in an audit, you're probably going to lose it. All right. So like if you go, say you go to a rummage sale, right? And you can't get a receipt, write it down on a piece of paper. Like, I bought this $50 desk at this little, whatever, a little flea market or whatever. They didn't give me a receipt. Write it down on a piece of paper. The IRS will accept that kind of stuff. They'll accept oral testimony. They'll accept lots of things. But you just got to make sure that you have someone representing you that's not scared.
How detailed does the mileage log have to be? Is it just, do you have to go into super detail or no?
What I do, and this is what I personally do, I let my mileage log run. And well, I'll say if it's business or personal, I don't really go into detail of like where I went or anything, because the log on My IQ, you can pull up the location, you can just pull up the address if they have a question during an audit. So I don't keep a written log. I'm not like, jotting down like I went to the, post office. My phone will have everywhere I went. And so in an audit, I would just provide that whole log, and it would, if they have a question of like an address or something, they can just pull up what that is, and they could ask me.
That requires that you're telling the truth on mileage.
Yeah, I mean, and I am very big. If you're a client, you know this. Like, I'm very big at reporting everything, only deducting what I'm supposed to, and doing strategy to help me get to zero. So I am always like, report all your income. Don't overstate your expenses. Be honest. But then let's do all the things that the government allows to get to zero. Because I'm not into the, if I have a client, if I have someone that purchases for me, and they do this sometimes, and they'll say, I don't report on my income. Okay, well, you're not a good client, you're not a good fit for me, and I refund them, because that's not my thing. I like for everybody to be honest, because I don't want to lose in an audit. I represent all of my clients in an audit. Carlotta personally represents the clients, and most accountants outsource that, right? I'm a bulldog when it comes to the IRS, but that is because I know my stuff, and I don't like it when I'm having to defend somebody who's being dishonest. I mean, mileage logs, yes, lots of people use estimations. I get that, and that's fine. Again, put MileIQ on your phone, let it run in the background, and I think that will solve a lot of problems. Because I don't think for the most part people try to be dishonest. I think they just don't know.
Business owners play fast and loose with deductions. And sometimes they do it because they don't understand.
Mhm.
And when you own a business, there's a gray area between what is and what isn't a business expense, right?
That's true.
And
Yeah.
so there's a lot of that.
Yeah.
Do you find that the IRS is okay with the gray?
I think if you have a good representative, the gray is fine, because
Okay.
you can explain it away, right?
Right.
Like yesterday, I had this client. We were brainstorming on a group call, and she was like, "Okay, Carlotta, my husband's having to live over here in this house 3 hours away. He has a home office there. How do we get him back home and deduct the mileage? Because he has to come home to run our brick and mortar store, and usually that's commuting." And I was like, "All right, this is what you're going to do. You're going to make sure he goes directly from the home office 3 hours away directly to the storefront, all
Mhm.
deductible. But if he went to his house first, none of it's deductible." So just playing within the rules of the IRS is so important. But most people would think that's commuting, because it's just going from one house to the office, to his store 3 hours away. But no, he has a home office there. So it's all about making the facts fit what you're doing. My biggest thing I tell people is, it's not can I deduct that, it's how can I deduct that. Quit asking your accountant, can you deduct something, and start asking them, how can I make this a deduction?
Do you find most accountants like that conversation, or are most accountants not want to deal with it?
I think if you say how, it actually gives them that like push of, can I do this? Instead of like, can I, they're just gonna say no. Okay. But also use ChatGPT. It is the secret weapon for learning how to deduct things. So I'll give you an example. Like, I had a client, and he was wanting to deduct his classic car collection. Every accountant would tell you no. Okay. You cannot deduct your classic car collection. But how can I deduct my classic car collection? It makes the accountant think, but it also makes ChatGPT think. Because if I ask ChatGPT, can I deduct it? It says no. But if I say how, I guess it's just an open-ended question. It'll give you like 20 ways of how you can deduct it. How can I deduct my swimming pool? If you say, can I? It's going to say no, but how can I? Okay, do you have a doctor's reason? Do you have a business where you give swimming lessons? Like, what do you have that we can make this into a deduction, right? And so, I do this with everything. If I want something, I want to know, how can I make it a deduction? And then I decide, do I want to do that or not? And so ChatGPT for the win. I love it, because it actually helps you to brainstorm when you can't get your accountant on the phone, or when they won't pick up for 6 months. But then if you have an accountant and you found a way to deduct it and they still say no, you need a new accountant, bro. Because that is a red flag. When your accountant acts like they're employed by the IRS, we have a problem.
Technically, they are.
Oh no, I'm not employed by the
Well,
IRS.
you are not, but technically, when you sign the return, you are representing that certain things are the case. That's what I mean.
Yes, but that is true. But think about this. That's the IRS is an entity of Congress. Okay. So Congress is the one making the rules here. And who is supporting Congress? It's the oil and gas, it's the companies, it's private equity, it's all these people. So when the government makes a rule, they make it usually for the benefit of someone. All right. Right now, we have a bunch of new rules coming out in the manufacturing space where they're making it easier. Okay. So the IRS is just there as like did you do this correct? Yes or no? I I go above the IRS and say, okay, what does Congress want me to do? Congress wants me to provide housing for people, to provide jobs for people, to do the things in society that they can't do. So how do I work that around, but still stay within the rules of the IRS?
And that's the key. You got to learn the rules of the game so you can play
For
the
sure.
game by the rules. And I think that that's a big part of it. So let's talk about some of the rules. What are the biggest things business owners miss out on for tax deductions?
Well, let's kind of go back to what is the biggest red flag on a tax return?
Okay.
Because I think that is, a lot of people are like so worried about what are the things they miss. You said people are like, they take a lot of mileage. Actually, when you audit people, a lot of people don't even take mileage that they're supposed to take. So
Hmm.
mileage is actually one of the biggest missed things, especially for business owners who are working from home. You aren't even thinking about, I had to run to the, Walmart or to the post office or whatever. So actually, you have two big extremes: people that way go over and you know that they're not going to have all that mileage, or people that are way under or have zero. Okay. So that's actually missed a lot. Home office is missed a lot. But you know why these things are missed? It's because the accountants are like, home office is a red flag. I classified returns for the IRS. All right. Home office is not a red flag. Mileage is only a red flag if it's super high compared to other people in your industry. But what I see as the biggest red flags are mistakes your accountant makes. Okay. Number one, it's the NAICS code they put on the return. So if they put your code, which your NAICS code is the type of industry you're in, if they put your NAICS code as a dance studio, but you're really a doctor, your expenses are going to be so out of line with the other people in your code, you're probably going to get audited because the IRS compares everyone in that code. And if your accountant puts nines or zeros, you are way more likely to get audited than the people that use the correct code because you're compared again to people in your industry. Now, if if you use the correct code, then what are the next red flags? Well, it's usually that your accountant put something on the wrong line. And so it creates a red flag. It's actually something that you have a legitimate expense for, but we don't know what it is. Or that your other line is super large in your sole proprietorship. Super large because the IRS actually can't see what's on that other line for some reason when they're doing their diff scores. So if you have a large other expense, that's not good if you're sole proprietorship. It actually should be moved onto the lines on the return on the Schedule C. Accountants don't know that because they didn't work
Well,
there. So they don't know what's a red flag and what's not.
but even the other line, you detail it on the next page. They don't see that.
You don't see it when the diff doesn't see it. They do on a partnership
Okay.
and on an S-Corp, but they don't see it when they're trying to compare. So it
So
leaves.
don't use the other line. Shove it
I
into.
don't like to use the other line unless it's very small.
And so the key there is to set up your bookkeeping and align it to the lines on your tax code,
You could do that. Yeah. If you're,
but but do it in such a way that you still have good data for you to make right decisions about your business. So there's ways to do that. We don't need to get into the details of that. Continue on.
okay. So what are some other things that they're missed? A lot of people don't realize when they're starting a business that anything that they turned into business use is a deduction. So if you started a business and you took a computer that you already been using and put it into use as a business, that's now a deduction. All right. And it's a deduction at the lower of fair market value or what you purchased it for, so lower of. But if you caught that and you did all the things that when you started the business, well, a lot of people don't realize every year you should be thinking through: did I move anything into my home office? Did I take anything from my house and start using in business? Did I take anything from my shop to start using in business? We do this a lot in my family. We'll buy a tractor for personal use. We won't ever deduct it, but then we turn it to business use. And if I wasn't thinking through that every year of like, we started using that in business, I would forget to deduct those things because I didn't pay for them out of this year. So make sure that you're making a list of all those things, giving it to your accountant. And it, like I said, it's the lower of fair market value or what you paid for it. Now, as we're coming into Christmas season, a lot of people are going to be getting gifts for Christmas that you're going to take to the office, you're going to use in the office, you're going to use in your business, something, cameras, coffee makers, those kinds of things. Remember, those are a deduction, even though you didn't pay for them. Maybe your mother-in-law paid for them, somebody else paid for them. It's a gift to you, but it is your basis in that is what they paid for it. So all of that is a deduction. Just make sure you grab the receipt or jot down how much they paid for it. Ask them. Usually, if you're getting that big of a gift, you're okay asking, right? And then, if your spouse maybe buys you something out of the personal account and tries to, hide it so you don't find out till Christmas, make sure that you get that and you put it on your business. All right. So the things that are the biggest issues are usually just it's large, unusual, questionable items. So when you get that return, you need to look over it and you need to say, would the IRS think this is out of line? The other day I had a client and he's new, and I was looking at his return and he had $200,000 of other interest on there. And I was like, what is this? Because if you pay $200,000 of other interest, you're going to know. They're like, that's not correct. I didn't have any other interest. When you sign that return, you're signing saying like your accountant did it correctly, right?
Do
Don't
you know? Because
things.
I do this for my clients. I look at their tax returns
Mhm.
and I want to tie it to their books and see. You
Yeah,
would be shocked at how often there are mistakes on the tax return.
I wouldn't be
I
sure.
have yet, I have yet to find a there are very few clients that will actually look at the details on the tax return. All they go is, how much am I getting back? How much do I owe? Where do I sign? Nobody goes through the details on it. By the way, I forgot to tell you, I'm an EA. So
Oh,
I'm
awesome.
geeky on all the
Yeah.
tax stuff as
So
well.
I
But
actually have not, in my 8 years, I've probably found 10 tax returns that were even accurate out
yeah,
of probably 1,000 returns I've reviewed.
in which case you can go back and amend a prior year.
But usually it's not in the client. It's usually in the client's favor. So I'm not going to amend it. I'm just going
Oh,
to be
well,
like, bro, like, what's your accountant doing over here? Because a lot of people, I guess the accountants, I don't know if this is true, but this is what I feel like happens. I feel like accountants get nervous towards the end of the year and they're not doing strategy for their clients. And so they're giving them this amount of like what they're going to pay. And then they just try to like add stuff to a tax return. That's what I assume because it's so blatantly wrong that I'm like, how could you do this without being intentional? I don't know. I just assume that. I don't really know how they're so bad.
there
I
are
can't
two
do,
groups. There's one group where I'm not going to say CPA,
or
I'm going to
EA
say
or whatever, the
the
preparer.
tax preparer is making stuff up and they're getting you in trouble as well as them.
Yes.
And then there's the other group where it's the business owner and yeah, that's a business expense.
Well, and there's the group of they don't let you deduct anything. They're like
Well,
so, like I said, they act like they're an IRS employee and they are
that's
so
of no
for
use.
the IRS that it's like you can't deduct a home office, you can't deduct mileage, you can't deduct this, you can't deduct that. And I'm like, what in the world? What you need to like let your accountant go so you can find someone who is working for you.
I have a
Because
question though. I think the 1120 has a balance sheet.
yep.
Does the IRS look at it? Because half the time the balance sheets are empty when I look at them.
Well, you're not required to do a balance sheet unless you're over a certain amount. So, yes, the IRS does look at the balance sheet, though. We are, because that's where you're going to find all your errors. I mean, you actually audit from the balance sheet when you're an agent. If you're an old school agent that was taught correctly, now the new school agents can't even read a balance sheet. But as an old school agent, I was taught how to actually audit from the balance sheet and not the income statement. So I cared more about the balance sheet than the income statement.
Interesting.
Yep.
And most people don't think that way. Let's talk about S-Corp.
All right. Let's talk about it.
Is that's like everyone thinks they need to be an S-Corp. I have found there's a subset of people that an S-Corp works for, but there's a lot of factors that go into it. And I don't even think most people understand the factors. And then the second thing is when you get up to a certain income level, being an S-Corp actually costs you money because you lose the UBI deduction unless you have somebody that knows how to do it well and make sure your salary and but I talk to accountants and they look at me and they're like, no, that's not the case. I'm like, yeah, it says so right there in the tax law.
You're talking about the QBI deduction.
QBDI, yeah, I always forget the initials.
Yeah. So, but also when you're an S corporation, you can do a lot more with QBI and you can maximize that. We do a lot of QBI maximization where we can save people a ton of money on their QBI deduction with an S corp. So it's, what I say is you don't ever need to be an S corp. Okay. First of all, you need to be an LLC, right? because an LLC gets to tell the IRS how they want to be taxed instead of the IRS telling you how to be taxed. All right. So you always start as an LLC, because if an S Corp election makes sense for you, you can go back and do an S Corp election back to January 1st. I mean, you can go back. I think the IRS, I don't think there's even a limit if you haven't filed a tax return to do a late S election. And late S elections are automatically accepted. Always be an LLC, because you can do so much strategy with that. So even if you're just starting out, I like to do an LLC. If you know if it's making money, okay? If you've got something to sell and you're making money and you're like, okay, this is going to be real. So I always like to start with the LLC because I can do strategy backwards. But then I say, don't even think about an S Corp until you're over 40,000 after expenses, after depreciation, after everything you have, you need to be over 40. Then we need to determine, okay, when does it make sense for you to do this? Now, we do Augusta rule with all of our clients. We cannot do Augusta rule on a Schedule C. So you have to be an S Corp to do the Augusta. So we usually, in our business, we have an FMC, which is a Schedule C, and a S Corp that's your strategy company. And then as you get bigger, we're also going to start a C Corp, because the C Corp, again, we can exit tax-free. And that means, like, when I sell my business, if I sell it as an S Corp or a sole proprietorship, I have to pay capital gains on every dollar that I made from selling my business. But if I'm a C Corp, I can exit tax-free up to $10 million a year, or $15 million now a year, per me and my spouse. So I love C Corps for that larger level. And then also, if we're trying to do any, like insurance policies where we do golden handcuffs policies or pension plans or stuff like that, a lot of times we want a little bit of money in the C Corp. So we deal with a lot of high earners. So we have usually a Schedule C, an S Corp, and a C Corp. But if we're talking about clients making under, a couple $100,000 a year, you really need to look at what state you're in, because some states you don't want to be an S Corp in. Tennessee, I'm never going to make you an S Corp, right? And no matter how much you're making. So it's just, there's a lot that goes into it, but do not ever even start looking at an S Corp till you're over 40,000.
Is there an upper limit to a S Corp? Like I've always said, because really the advantage of the S Corp is you don't pay the FICA tax.
Right?
That's the biggest advantage. Yes, you get the Augusta rule. The
Yeah.
downside is if you employ kids, you don't get
Well, so
to
in ours,
employ them FICA free.
we have an FMC though. So if you're working with us, there is no upper limit, because we are doing so many entities, because our goal is to get you to millions, right? So we have an FMC for everyone that comes on, and we have an S Corp. We have both. And if they're over, 40,000 and they're actually making, and then we also do a QBI maximization, where a lot of times we can actually get your QBI maximization over what we could is if you were a sole proprietorship, because of everything that goes into the QBI maximization. So I would say on the upper side, it really depends on a lot of different factors. Also, if you're an SSTB, which is like accountants and doctors and lawyers and whatever, on those, I really like to try to get a break off of some income. Like, okay, like yesterday I had one that she's a nurse, and she's going in to set up all these different companies for people, and she's getting all of it through a 1099. And I was like, okay, let's split this into two different businesses, one that's passive, one that's non-passive, because we do a lot with investments too. And so we're trying to offset all of her passive with like syndications, oil and gas, that kind of stuff. And then with those losses, and then we have the active income that we're trying to do other strategies with. So it really depends on if you have a tax strategist, I would say, because for us, we do a lot of high-end planning like that, but most accountants don't. Okay. So you got to be really basic.
And that is really the key. One of the things I have also talked to is if you have partners, is to have multiple entities, meaning the business itself is one clean entity, is what I call it.
Absolutely.
And then each of the owners is their own entity, so that when business owner A says, I want to buy a sports car, and business owner B says, I want to buy an airplane, they don't fight. And
Yep.
when business say, I want to hire my kid, and business owner B says, I want to hire my wife, you're like, no, you put those in your own places.
We call that our strategy company. So
Okay.
every person has a strategy company, and you do not mix your strategies with other businesses. Now, that's your strategy company, your holding company usually, and that's where you're going to do your strategies. And then you'll have every partnership is separate. All right. But like another thing we have right now, we have a guy that's doing software. Okay. And he has like 10 software little arms that he's wanting to create. And each one of them are sellable separate. And the question was like, should I have all these together? Well, no, because each one of them are going to have different partners. You can't do that, right? And so he was like, okay. I was like, but you really need a C Corp holding, but you need C Corps under each one, because when you want to sell that arm off, it needs to be able to be, available to do that through 1202. So the companies you're going to sell off, if you're here and you're like, okay, I want to sell a business that I have, like maybe it's a pest control or chiropractor, whatever. All these businesses nowadays, they all are sellable. Okay, if you have a business that's not sellable, it's because you didn't know it was sellable, because their private equity will come in and buy it. All right. Or somebody else will come in and buy it. But those sellable companies always need to be a C Corp 5 years back. So for us, we set up a lot of different entities because our clients are growing, right? Also, you never mix your real estate with your active income, right? So your real estate, we have a branch, right? So you have your active income on one side and your real estate on another. Real estate should never, ever, ever, ever be in with an S-Corp or anything like you want those into a separate company, whether you can do a partnership or a sole proprietorship, but do not ever put real estate into an S-Corp, because you're going to have gains that you would not have on a partnership.
And that is where people make mistakes. That's why your business shouldn't own the real estate also. You keep them separate, you run them differently. That is all very much makes sense. You also talk about how business acquisition can help lower the tax bill, because if you buy a business that's losing money and has lost money for a while, there's a whole bunch of tax deduction inside of it, isn't there?
Yeah. So when we're looking at selling, usually it's going to be a business that actually is obviously made money, right? So, if there's a lot of losses, we're probably going to sell in a different way, probably having a more of a asset sale or something like that. We probably aren't going to do a C Corp. But also, if you have a bunch of losses, when we're selling, we have to do a bunch of add backs, right? So we do a lot of this at our company because we do a lot of exits. We do a lot of mergers and acquisitions and exits. So you got to add all those things back. I'm going to tell you, if you have a company that you want to sell, about 5 years before you sell, you need to get those books crystal clean. No personal expenses out of there. Create another company for that stuff. Nothing that is, like make that thing make a profit, and then except like depreciation, you can obviously have that, but like everything else, like all your strategies, all your fun stuff, all the things that you're wanting to deduct, that's like, how can I deduct that? Put those in a separate company 5 years before you're trying to sell it, because we really don't want any losses when we're trying to sell. We want it to be, a great company that someone wants to pay money for.
Correct. And that's what business owners don't realize. If you don't pay taxes and you don't show profit, nobody wants to buy your business.
Oh, true. And you just have to show profit in that business. The other business can be a loss they offset, but that business needs to be making some profit.
Yeah. So that's a big part of it. I know there's a million things to talk about. We're getting towards the end. Is there anything that we really should have talked about but didn't touch on yet today?
I think we're good. Like, I could talk all day about this. Hopefully I've hit the high points, but I think that as we leave this, you guys, if you are trying to have a successful business, it's super important that you have a system of cash flows and budgeting and whatever that looks like, because the number one reason businesses fail is cash flow. And that is why the profit first system works so well, because you should not have cash flow problems. So if you're finding yourself not using that system and having to move money around all the time, get on the system, learn how it works, because if you're using something like that and you're using it accurately, there's no way to go under, because the way the system is set up, you should never have a bill you can't pay. So that's what I'm going to leave you with. And thank you for having me here. I love all things tax law. We have a training every week for 2 hours. And so if you want to get on our training, you go to taxstrategistofamerica.com. We'll also have a link in the show notes where you can sign up to come to one of our trainings. And when I say it's like a college level course for business owners. So if you liked what you heard today, come to one of our trainings and learn more, because we go over tax strategies that you can use leaving there. Like, we'll tell you what forms to fill out. We will tell you everything. So it's not like a big sales pitch. It's like, okay, this is what you can do to save money today.
And that's the key. And I will tell you, because I, like you, love to read about tax code. And what I have found is it is not well understood and thought through. And there are a lot of these different things like that we talked about today, where you have to have different entities, where you have to think about, well, if I do it this way, it's tax deductible. If I do it that way, it's not. And a lot of these things are quite simple. For example, if the post office is next to the grocery store and you happen to go to the post office, that mileage is deductible. And then you pick up your milk on the way home. So be it, right? It's little simple things like that that most people don't think about. I think the problem is most CPAs don't have the time, or most tax preparers don't have the time to have these conversations. And you definitely don't do it in February, March, and April. These are things that you've got to do well in advance and outside of tax season.
Exactly. And our company works with your accountant. Like, we work with accountants all across the nation. So if you want to do tax strategy, you should be starting on 2026 strategy that you're going to file in 27 in January. You should have started working on 25 strategy that's filed next year, last January. And so you got to do it early, because right now we have people who are trying to get things in before the end of the year. But once December 31st, you're done. You can't like go back and change something. I mean, yes, you can do a defined benefit plan or a cash balance plan, or, some retirement stuff, because it has an extended deadline. Maybe you could get in on a solar credit that can go back 3 years. But guys, like, there's just out of time. And so we got to make sure that we're doing it way before December 31st.
That's correct. And I think one of the worst tax strategies is buying an overpriced vehicle that you
Oh my
don't need.
gosh. That's not even strategy. That should be outlawed. If that's your accountant's idea of strategy, please fire them.
I get it. It happens. Thank you so much for joining us today.
Thank you. Talk to you soon.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.